All right. Today is Sunday, the 5th of May. Happy Cinco de Mayo. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. You know, this week that was in the stock market is really interesting for two reasons. Reason number one, we're now, let's say, past half of this earnings season, and we're past, let's say, 80% of the most important names, the big technology names. We only have one name remaining, which is NVIDIA. We're beginning to see a clearer picture of what's going on with different corporate earnings and what they say about the economy. And of course, the beauty of earnings season is when you pick your stocks, it is judgment day. The report comes out, either you justified or not. Either your stock blasts higher, justifying the fact that you bought it, or it crashes down on your head, down 10, 20%. And if you ate a bag in one of your recent picks in the market, don't feel bad about it. It happens to the best of us. Even the greatest one of all time, the Big Buffet, ate a bag of dicks in Paramount. Lucky for him, of course, the Federal Reserve is manipulating financial assets higher, so his trash banks are moving higher, and the iMob and Apple are manipulating the stock higher via share buybacks to cover for the abysmal report that they gave us this week. That's the good news for the buffet. The bad news is, when this crash takes place, it's not going to spare Berkshire Hathaway. Way overweight in Apple, way overweight in financials. They're going to go down with it. The good news, though, after that, they have an insane amount of cash, and if they don't waste it right now, when everything crashes down, Berkshire Hathaway will go in a shopping spree, and that would be the generational buying opportunity. Not right now. What's going on right now is a generational bagging opportunity. So when we say that a crash is good, believe it or not, it is. You get to buy assets at a cheaper price. But the point being, folks, we'll talk about earnings and see what we have so far from the reports that we got. But this week was interesting for another point. See, as we were heading into Friday's session, I was saying to my viewers, it could be a decisive day. You got to remember that we are in the chop zone right now. What does that mean? It means the stock market been going higher with no counter at all until, of course, the bears got something they can hold on from the data, from the change of data, shall we say. We got a decent leg of correction, but now, after the correction comes the recency bias of, dips are bought, and then you have the other side that says, no, things change, and it's a battlefield. Back and forth, back and forth. Really challenging to trade. And you'll notice that you're going to make mistakes, and you're going to have losing trades. Even the best traders will fall into the same problem. And this is why we say Sun Tzu, right? Pick your battles. Sometimes you have to stay in the sidelines. Wait for the chop to be over. Wait for a clear, victorious side, and then you follow. The question now becomes, did we get a clear victory on Friday? One way or the other. Did the bulls win the narrative back? Or are the bears still winning the narrative? That's what we're going to explore in this program. We're also going to explore the macro because Zombie Powell, the chairman of the Fed, came out this week. And of course, everybody's talking about the phenomenon of stagflation in the economy, the slowdown of economic activities while we see inflation going higher. All eyes were on Mr. Powell. Will he acknowledge that we're beginning to see a phenomenon of stagflation in the economy, and perhaps that's going to change his approach toward monetary policy? But of course, Zombie Powell came out and said, I don't see any stagflation. I don't see the stag or the flation. Take a look.
That last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be. So I don't see the stag or the flation.
So in this program, we're going to help Mr. Powell here to see the stag and the flation. But perhaps there's also a problem with his prescription. We're going to try to help him out in that endeavor too. And without further ado, here it is, folks, the macro coverage for today. In focus tonight. Better vision awaits you, Mr. Powell, courtesy of the Maverick for Wall Street and his viewers, of course. We'll help you out. You say that you don't see the stag or the flation. Well, let's help you out a little bit here and show you a few things. Maybe we'll convince you, but if that doesn't happen, we're going to have to help you with your eyeglasses, because I think that's the problem. We talk about the stag and flation. The combination of stagnation, inflation equals stagflation. Now, inflation is clear cut. If we have inflation going higher, okay, you got an inflationary process in the economy. The stag is not clear, though, at least for some folks. It's clear to us. viewers of the show, but not to a lot of other people, specifically in the Federal Reserve building, because they measure stagnation or lack thereof in the economy via the GDP, the most manipulated number in economic history, the most irrelevant economic number in history. Anybody who studied economics before knows that the GDP is bullshit. What you need to look for is the consumer and the pace of growth in the economy, in manufacturing, in services, and in between. Are we seeing a slowdown in the pace of activities or not? Well, that's indicative of stagnation in the economy. Now we have to look to the other side. If you're seeing a slowdown in the pace of economic activities, you look toward inflation. Are prices going down along with the slowdown in the pace of economic activities or not? If they are, okay, then we have probably a slowdown, perhaps some recessionary impact in the economy. But if we see inflation going higher, despite the fact that we have the pace of economic activities slowing down and in certain corners actually been negative for a while, then we have stagflation in the economy. But of course, Powell says that he lived in the 70s back in stagflation, and it doesn't look like it at all. As if he's waiting for the crisis to deepen, to the point where you feel it, you feel the pain, where it's obvious to everybody that we have stagflation in the economy. No. The job of the Fed is to spot it before it happens. But the Fed sucks at doing that. Case in point, the transitory mistake. So let's look at the data and help Mr. Powell here. Here's Nick Timiraos. He's the Wall Street Journal reporter for the Fed. And of course, he's a kiss ass for the Fed, but I don't blame Nick. You gotta do the job. You need access, so you have to kiss ass. But since he's one of those trusted sources, I'd like to use him. And here's back from December 23, back when we were talking about the light at the end of the tunnel, when Powell came out in that FOMC meeting, smiling ear to ear, declaring victory, that inflation is gone. Next step will be rate cuts. Stock market was blasting higher based on the promise of rate cuts. The dollar was going down. Bond yields were going down. Everybody and their mothers were saying that the economy is now heading to a soft landing and this is the beginning of a bull market. How did inflation look back then? If you look at the annualized rate, whether we're talking about 6 month or 3 months, they were all trending down, some below the Fed's target of 2%. On face value, you look at this and say, yeah, the Federal Reserve got it, mission accomplished. But if you have any brain cell that is not fried yet in your head, your job as an economist, as a Federal Reserve official, is to use the input data that you got right now to project what could happen in the outlook, in the future. If we do X, what will be Y? If we don't do X, what is the outcome? And we said in this show that declaring victory prematurely and talking about rate cuts will rebound inflation, because inflation is also a psychological phenomenon. And here's what we have right now, once again from Nick. You can see that inflation is now rebounding higher. If you look at the closest annualized rate for 1 month, or in this chart, 3 months, you can see that inflation has rebounded significantly higher. And anybody looking at this trend right now, anybody on their right mind, of course, would never argue for rate cuts when you see inflation rebounding like this based on the promise of rate cuts, not to mention actual rate cuts. So this is one example, Mr. Powell, if you're listening, if you're watching, better yet, if you're watching. This is just one example to show you the Flation side that you cannot see. And since we're talking about eye exams, Mr. Powell, if you're watching, here it is. Let's do this. Can you see this? 1, better, or 2? 3 or 4? Can you see it better now? But if that was not enough, let's cover more of the economic data that we got this week alone that shows us the Flation part that Mr. Powell doesn't see. This week we got the ECI, the Employment Cost Index. And here's the headline: labor cost rise at the fastest pace in a year and a half. You still don't see the Flation here? But I know. Powell says, yeah, the rise in wages, that doesn't cause inflation. Maybe the guy should be back in college, taking Economics 101, not leading the Federal Reserve. You can see in the chart of the ECI, the trend is not good. It points out for rebounding inflation. Then we got a confirmation of this data. Later in the week, we got labor cost, unit labor cost. Here's the headline. Unit labor cost jumps 4.7%. This is the most in a year. Now, you might say, yeah, but unit labor cost moving higher, but productivity is also moving higher, so it evens out. No. Productivity going down. By that piece of data alone, you should be alarmed about the future of stagflation in this country. But here's the illustration for you. You can see that unit labor costs moving higher, and then productivity dipping down. More Flation for you, Mr. Powell. We got the Case-Shiller Home Price Index, and the headline, here it is. Home prices soar even higher in the month of February, despite higher mortgage rates, says the S&P Case-Shiller. And by the way, my former home base in San Diego, the highest inflation rate in the nation. And you wonder why I'm so hot about inflation? Anyways, now let's talk about the Stag, Mr. Powell. I just showed you some examples about inflation. Let's talk Stag now. We got the Chicago Business Barometer this week, and here it is. Chicago Business Activities Index weakens in April to the lowest level in 17 months. You don't see the Stag? Okay. Here's more. Job openings in the United States fall to the lowest level in 3 years. I know what Powell was going to say, but we're just cooling from overextended ratings. He wants to play that game now. He wants to wait till we get the actual stagflation when it's clear to everybody to say, hey folks, by the way, we're in stagflation now. But if that was not enough, Mr. Powell, here's another one for you. When we talk about stagnation, the consumer is, of course, front and center. Consumer is the driver of the economy. When we look at consumer confidence, drops to 21-month low. Worries about food and gasoline prices. And on top of that, Americans now think that the jobs market is getting weaker. And if you look at savings, consumer savings, that's also dropping like a rock. And of course, Powell loves to manipulate the data. He would look at this and say, oh, but this is good because that's cooling inflation. Okay. He wants to play that game again. He wants to play transitory 2.0. And by the way, he memed himself into a corner by saying, I don't see the stag or the inflation, because that's going to be a huge meme as we continue to get data pointing out for more and more stagflation in the economy. This week, we also got construction spending. And the most alarming piece of that data was the 1-month hiring rate. It was the biggest drop in history. And this is supposed to be one of the hottest sectors in the economy. Now, we stitch it all together. The inflation part and the stag that we just talked about. What do you got? You got stagflation. Here's the illustration for you. Here's the results. You look at the Dallas Fed manufacturing outlook for wages and benefits in blue. That's trending higher. That's inflation, right? Then you have the outlook for the number of employees trending down. Another clear evidence that we're beginning to see the stagflation phenomenon in the economy. If you look at the manufacturing ISM index, the reading is dipping below 50 again, so it's trending down into contraction territory. Then you look at the index for prices paid, that's moving higher to the highest reading since 22. Combination of both, stagflation. And to seal the deal, on Friday we got the Services ISM survey, and this was the clearest illustration for stagflation in the economy. So if you look at the percentage point change month on month, the headline reading down 2 points, business activity down 6.5 points month on month, new orders down 2.2 points, employment down 2.6 points. Then you look at prices, that is up 5.8 points month on month. Come on, you really don't see the stag or the inflation, Mr. Powell, or just jerking around? I know what you're going to say, but what about the jobs number by the cooks this Friday? That was the reason why the market went higher, because the economy is slowing down. We're producing less jobs, and wages are going down. There is no stagflation, there's just the economy's still booming, I guess. Here's the problem with, despite the cooking, of course, of the employment data that we got on Friday. You can see that the rate of inflation, consumer price index, trending higher, average hourly earnings, if you trust the cooks, trending down. In other words, once again, workers will lose to inflation. And they've been losing. The data is just fake. We've been losing to inflation. But now it's going to become official. And that's yet another confirmation for stagflation in the economy. When you dig deeper into the employment report, the majority of jobs being created are in the health sector. We have an aging population all over the place, and we have the spigots of the government spending with no receipts, with no watchdog at all, and Medicare scams and all of that. It's a gold mine. And by the way, anybody who's involved in healthcare services businesses, you know that hiring is really hard. In the city of Las Vegas, for example, if you want to get a nurse, it will cost you an arm and a leg. You have to relocate other nurses from across the country, and that's going to cost you. And that's inflationary. Other sectors in the economy not producing any notable jobs, really. There was a clear hint of stagflation in the pace of hiring in other sectors in the economy besides government and healthcare. And the only folks who don't see stagflation is the Fed zombie and regime propagandists like Paul Krugman, who says still no stag and not much inflation. Of course, this is Paul CPI X everything Krugman. He's a fake economist. He's a propagandist for the regime, but they gave him a Nobel Prize just to legitimize him. I mean, this is the same guy who suggested that the government fakes an alien invasion to issue stimulus and pump the stock market higher.
I actually have a serious proposal, which is that we have to get a bunch of scientists to tell us that we're facing a threatened alien invasion. And in order to be prepared for that alien invasion, we have to do things like build high-speed rail and then once we've recovered, we can say, whoops, there were no aliens. But look, I mean, whatever it takes, because right now we need somebody to spend.
So again, Mr. Powell, here it is one more time. 1 or 2? 2 or 3? But I know we need a real eye exam. We need to give the guy a legitimate test here. Give him the benefit of the doubt. Maybe he's not seeing things clearly these days. I mean, he's coughing all over the place, probably got emphysema. Maybe the guy's losing some vision too. So I decided, folks, that I'm going to write a letter, and I'm sending this Monday, tomorrow, to the Federal Reserve, addressed to Mr. Powell, and I'm going to volunteer with other group of concerned citizens to pay for Mr. Powell's next eye exam. We will even pay for his next pair of prescription glasses. It's a really kind offer. Doesn't matter. You want to go to the best doctor in D.C., we'll pay for it. You want to buy the most expensive pair of glasses, we'll pay for it. We just need you to see things clearer, Mr. Powell. And here's the letter that I wrote to the Federal Reserve, addressed to Mr. Powell. Give us some dramatic music while we read this. Here it is. Dear Mr. Powell, I recently watched your latest FOMC conference, and I've been struck by your statement dismissing a stagflation phenomenon in the economy by saying, I don't see the Stag or Flation as a representative of a group of concerned American citizens who do see the Stag and Flation in our everyday lives. I'm concerned by your statement. Initially, I thought maybe being the richest Fed chair in history and living in an elitist bubble might have clouded your judgment about the reality of stagflation that many of us are facing. And by the way, Mr. Powell, he says that he's so in touch with the middle class. He's happy with his Fed salary of $400,000 a year. He doesn't need more. Matter of fact, he's so humble. He bikes to the Fed, he says. Middle class Powell bullshit. How much do you want to bet that he doesn't bike to the Fed? That he actually goes with a bulletproof SUV and bodyguards? That's how he rolls to the Fed. And of course, while Chairman Volcker, who actually defeated inflation, saved this country and gave us the prosperous 80s and 90s, was only worth $142,000. He was in touch with the middle class. He didn't care about the elite. He was attacked when he was fixing inflation, but he didn't care. He cared about the legacy after that, and most importantly, the future of this nation. Mr. Powell, on the other hand, was worth over $100 million. That's back in 2017 when he became a Fed chair. Rumor has it now he's worth over $300 million. Thank you, of course, to the insider trading activities he's been doing for a while now, and selling data and insider information to his buddies in Wall Street. See, Mr. Powell was caught doing insider trading, and then he decided to investigate himself, and he didn't find that he did anything wrong. He doesn't know nothing about nothing. The guy hasn't been middle class for 50 years. Actually, he was born rich, so he's never really been middle class. And that's the Fed chairman? That's who you think gonna fix the problems in this economy? We need a Fed chairman, chairwoman, who actually comes from the middle class. Their priority would be the health of the American consumer. The middle class, not the elitist cult. Anyways, back to my letter. I thought maybe being the richest Fed chair in history and living in an elitist bubble might have clouded your judgment about the reality of stagflation that many of us are facing. But then, it occurred to me, what if your vision is not as well as it used to be? Question mark. What if a new eye exam and prescription glasses is all what it takes to clear up your vision enough to see the reality of stagflation in the economy? Question mark. Therefore, I and a group of concerned citizens are volunteering to pay for your next eye exam and a fresh pair of new eyeglasses. I attached a list of the best optometrists residing in the DC area for your convenience. We also understand that you're a man of wealth and great taste and style. So please, we have no reservation of the brand of eyeglasses you choose, no matter how expensive it is. As a concerned citizen, a healthy vision for the Fed chair is immensely important, not just to see the realities of the economy, but also to keep our country's finances in top shelf shape. Imagine if you fall and you can't get up because your outdated pair of glasses? Question mark. Who's going to take charge of the printer press without your capable hands? Question mark. Who will reassure us that we are indeed on the path to reaching $40 trillion in national debt as soon as possible? Question mark. Who will maintain and prop up the stock market and real estate bubbles? Question mark. As a proud American citizen, I believe that my country should be number one in any competition. It is a shame that we're losing the debt-to-GDP race to countries like Greece, Japan, and Venezuela. You see, Mr. Powell, for the sake of this country, we need you to have a healthy vision. Please accept our offer. The Maverick of Wall Street, a concerned citizen, Las Vegas, Nevada. Now, I know some of you said, hey, but Maverick, Powell is going to call the FBI if you send this letter. I got that covered. Most of my neighbors are FBI, and they don't like the Fed either. What if he calls the CIA, Maverick? It's okay, I got my connections back when I was interning for the State Department. What if he calls the local cops, Maverick? Rest assured, the moment I moved here, I donated, aka greased a bunch of crooked cops and judges and politicians. That's what you do when you move to a new place. It's the American way. So I'm covered. But if Mr. Powell decides to contact the Boeing assassination unit, oh boy, we're in trouble because they don't miss. See, in Boeing, they don't like rats. Once you're in the family, you can't leave. And if you leave and you start talking, you're done. Oh, he slipped on a banana peel and fell off a window, and the guy died. So tragic. Even Putin is jealous right now. But anyhow, folks, if you're going to volunteer with me in this endeavor of financing Mr. Jerome Powell's next eye exam and new pair of eyeglasses, just understand that it's going to be really expensive. He's a man of great taste. I mean, with a net worth of $300 million, and you're over 70 years old, you got one foot in the grave already, but your ego's too large, doesn't allow you to retire. You gotta buy a lot of expensive stuff. So Jay Powell has an expensive taste. He loves those Rolex watches, 60, 70, 80 grand a piece. He owns multiple pairs. And I decided to do my research on his eyeglasses just to find out maybe the brand that he likes. And he has this pair. This is his favorite pair. I think this is the Prada, but I'm not sure. Then he has another pair, which is really close in style and design to the first one, but it has a different coloring. I think this is Armani. I'm not sure. Then he has this one right here, and this one is clear. This is Oliver's People. Good taste. Here's another look at it. Really good looking pair of glasses. And then he has this dark green pair of glasses. He only uses that when he's printing. And of course, the no lower rim pair of glasses. But, you know, with these nose pads, I don't think Powell likes them anymore. And then, of course, once in a while, you got your contact lenses or just go blind. So since I know at least one pair, I don't know if you guys can identify the other pairs, but at least we know that he admires Oliver's People glasses. So we went to the website here. They have new styles, Mr. Powell, if you're interested. They have a new one called the Mr. Federer Reserve Chairman. I do like the other one, though, on you. The Josanne. I think you need a clear pair of glasses on you. What do you guys think? I think you look good with this pair of glasses. But if you want to go with another look, Mr. Powell, you got the OP47. That'll give you the same look as former Fed Chairman Arthur Burns, since you guys are going to have the same fate anyways. But look, I'm ready for any pair of glasses you admire, Mr. Powell, even if it's more expensive, such as Cartier, or anything even more than that. We're ready, we're able, and we'll do it, because a clear vision is good for this country. Now, let's segue to the market dynamics and what happened this week. Do we have a clear side that won the chop-chop battle? Do we have another easy, juicy leg to trade this week or beyond? Let's retrack the market dynamics and see who won. We're going to play a game called Landmines, and here it is. So you got the bull, you got the bear, and they have a line of multiple landmines. Every landmine is going to detonate. It's going to hurt either the bull or the bear. Whoever gets away unscathed gets a point. So let's begin. The first landmine was last week when we got the earnings of Meta. And of course, the reaction was the stock went down by over 10% because the company's now spending more and the margins are not going to be as good as they used to in the last year. So this was a landmine that detonated, hurt the bulls, but the bear got to pass unscathed. So bears 1, bulls 0. Then we have the next landmine, Microsoft and Google's earnings. Well, the reactions, Microsoft was up by a little bit, then faded, and you got Alphabet blasted higher, gains of more than 10%. So in this landmine, it detonated, it hurt the bears, but the bull got to pass unscathed. That makes the score, bears 1, bulls 1. Next challenge, we have the PCE report. And of course, we only get the major ones. So I know what you're going to say. What about the ISM, Maverick? These are the death by 1,000 stamp. We're talking about the main events here. We got the PCE report. We know, if you looked at the data they just showed you with the 3-month annualized rate, that this landmine exploded and it hurt the bulls, while the bears got to pass unscathed. So bears 2, bulls 1. Then we got the next landmine from AMD and Super Microcomputer earnings. Why are they important? Because it is a leading indicator to the big kahuna NVIDIA. If they're not doing so good, then are we seeing the peak of the AI bubble? And of course, AMD was lousy. I thought they'll do better, but they did not. It was absolutely horrific. And then you have Super Micro. We covered the earnings in details for the members and why it was problematic. And the reactions of these stocks tell the story. Both of them went down big. So this landmine detonated, and we see the bulls getting hurt, the bears gaining and moving with no harm at all. Bears 3, bulls 1. You could see the market reaction at that point, folks. When the bears were up 3-1, the market was getting down dramatically. So we're not just playing a game here. You have to set your landmines for next week and continue to play the game, and it'll show you where the market is going to go. The next landmine was Amazon, and in my opinion, the report was the best among the large cap technology stocks, and we've seen Amazon going higher after that. So this landmine detonated, hurting the bears, but the bulls got the pass. So the score right now, bears 3, bulls 2. We get to the FOMC, and of course, Powell comes out dovish. I don't see the Stag, I don't see the Flation, I don't know nothing about nothing. Just shut your mouth and buy stocks, and we got a soft landing. Everything is in the bag. And it appeared initially that this is going to be a win for the bulls, but the market reaction was telling. We had a pump and then dump by the end of the day. So I'm going to consider this as a landmine that detonated, hurt both, but there was no clear victorious side. So we're going to call it a draw, and that means bears still 3, bulls 2. Then we get to the next landmine, which is Apple's earnings. Now the report was absolutely horrific. iPhone sales down 10%, sales in the North Americas down year on year, sales in China down year on year. The only segment that's up year on year is the racketeering revenue from services, but the regulators are coming after that. So it was a huge defeat for Apple, but they covered for all of that by initiating the largest buyback ever. And mission accomplished. The stock goes higher. So this landmine detonates, hurting the bears, aiding the bulls. The score now goes 3-3. And you see the market beginning to recover. Things are beginning to even out. Then comes the last piece of data, the last landmine that we got for the week, the jobs report. Decisive, yes, because the score right now is 3-3. Well, the report comes out mild. This is what the cooks gave us. And we see bond yields going down, the dollar going down. It appeared as a clear victory for the bulls. But then came the ISM services data. And we've seen the dollar rebounding, bond yields rebounding a little bit. But the market at the end of the day, after digesting all of the data, decided to close at the highs of the day. So we're going to give this as a win for the bulls. And now the score stands bulls 4, bears 3. And now you understand why the market zigzagged back and forth, and ended up closing at the highs of the week. Now, in my scoreboard of the bulls versus bears battle for this week, I would give the technicals to the bulls. And hear me out here. I issued a morning brief on my Discord, and I gave you the exact numbers. SPY, if we're above this and that, we're bullish, we're bearish. Qs, E-mini, NASDAQ futures, dollar, you see it right in front of you here. All of them gave us bullish confirmations. Now, I also gave you a bunch of trades if that happens. The XHB, IYR, IWM, Qs, SPY. And if you followed them, you might score this coming week. But did I follow them by the end of the day? And I told you we have to wait till the end of the day after the market digests all of the data to decide what we're going to do. But again, if you followed any of these, you're probably going to do a lot better than me. But what I decided is, you know what? It doesn't sound or look as clear as I thought, as if we're going to have a clear victorious side. Now, see, if the services ISM data came out confirming the jobs report, I would have said, okay, clear win for the bulls, higher we go. Bet on it, 100% sure. But I hesitated, and I decided to go with the VXX, this is the VIX proxy, 13 calls, expiration date next week, and the SQs, the inverse of the NASDAQ, the 11 puts, so we're betting that the NASDAQ goes higher, also expiration date next week. All in all, 50 cents for the whole exposure. I'm not going to risk any more than that. Sun Tzu, pick your battles. And I don't think that next week, at least into Monday, is going to give us a clear, decisive side. I've been doing so good in the last few weeks. Why screw up the job and enter trades for a week that you're not really sure about? And again, I say that because the ISM services data, number one. Number two, look at the reaction that we got in the dollar. So the payrolls come out, and we see a big flush. Then the ISM gets out and we see a recovery. Of course, the market did not do the 180 as the dollar did. But this reaction by the dollar says you gotta be careful. There is no clear victory here. And the other reason is Mr. Bear is not really that far away. He just needs one piece of data and he'll catch up with the bulls. See, all the way to late March, the bear was not even in the map. The bear was hiding in hibernation. There was no resistance at all. But then we began to get more and more pieces of data indicating that, wait a minute, rate cut's not going to happen. And there is a high probability the next move will be a rate hike. Then we've seen Mr. Bear entering the chat, and now it's not clear that Mr. Bear is scared just because Powell dismissed the idea of rate hikes. The traders are now betting that Powell doesn't matter. Rate hikes still have a great chance of happening. And the ISM services data gave more ammo to these kind of bets. So I'm not confident that the bear is out of the picture yet. You stitch it all together, and I give the win for the technicals for the bulls, but it's a slight victory. It's not a decisive one. Now, when it comes to the macro battle, of course the bears won. The bulls got one piece of data from the employment report, but every other piece of data was pointing out for stagflation. When it comes to earnings, who won the battle? I have it as not really sure. It's in between. So if you look at the mega cap companies, ex-Apple, of course, ex-Tesla. Oh, I'm sorry, Tesla's not a big cap anymore. It's Apple. Apple was lousy. But then you look at Microsoft, Alphabet, and Amazon. They were pretty good. Companies doing B2B are doing okay in the economy. Companies doing B2C, that's a different story. So you look at the contrast here in the EPS estimates. For the 493 stocks in the S&P 500, they're plummeting down. For the Mag 7, they're actually surging higher. So we have this contrast in the market. If you look at the Mag 7 side, or Mag, 3 now? They're doing fine. But then you look at the rest of the economy, specifically business-to-consumer companies, and it was an absolute disaster. We got warnings from McDonald's, from Starbucks, from DoorDash, from Etsy, from eBay, from Kraft Heinz, and before that from PepsiCo. Every company dealing with the consumer is now warning that we're seeing cracks here. And we're not sure if we up our prices, whether we're going to survive or not. Whether that's going to make up for the loss in margins. And this is why we've seen a lot of these stocks going down big. I mean, look at Starbucks down huge for the week. So again, it depends where you look at. If you look at Amazon, you'd say, oh, earnings were bullish. Absolutely. But if you're looking at the consumer-led businesses, you'll say that, oh, the bears got it. So we're going to leave it as neutral here. Then we have the last category, the Fed. Who won the Fed? I gave it to the bulls, and hear me out here. Of course, the bears got some arguments on Friday from Governor Bowman, who said that she's still willing to raise rates. Kashkari says he's still open. Got it. And then you have Powell, who says, no, we're not going to do rate hikes. Rate cuts are coming. It's just a matter of when. At the end of the day, I trust what the charts tell me. I trust what the reaction of the bond market tells me. And here's the chart, the 10 minutes chart of the 2-year yield. The government report comes out, we see a big flush down, indicating, wait a minute, rate cuts are coming. Do we get the ISM services data? And we see a rebound. But it's not a recovery as we've seen in the dollar. It is still down. And this is why I give it for the bulls. If we see the 2 years recovering this week, then things will change. And that could happen just as easily. And this is why I don't think that we got a clear victorious side. And this is why I'm not really confident this week that if I just go all in and bet that the market is going to recover, I'm going to score. So I'm taking it easy right now. Matter of fact, I might not even trade as much this upcoming week. We're going to take the week off. Not even daily videos. This is going to be bonus week, folks. For the members listening right now, it's going to be bonus week. So bonus videos, educational videos. If we get a major reaction or movement in the stock market, we'll do a smaller video, shorter video, just to cover the details of the day. And now watch, since I said I'm going to be out this week, the market is going to crash. Just when I thought I was out, they pulled me back in. And that, by the way, happened last time around. And in the first leg of this correction, I was actually traveling and the market was going down. But luckily, with the phones and all of that, we were communicating while I was waiting in the airport, in Uber rides, in bathroom stalls, and it worked out. We did pretty good. We were in touch. This week, if it happens again, we'll be in touch. We'll cover it, but it's going to be the assumption is it's going to be a week off. Now, a lot of trading. You don't need to get engaged in a battle that you're not really sure about. With that, folks, that wraps up our macro and market commentary. But we're not done yet. We still have the market information for you. So let's cover that, and we begin with the closing of the indices on Friday, and here we go. The diamonds in the green by 450.02 points, or a gain of 1.18%. The Nasdaq leading the day higher with 315 points, 0.35. Or a gain of 1.99%. And the Spider also positive by 63.59 points, or a gain of 1.26%. The Russell 2000, this is again part of my hesitation. If bond yields are going down and it's all clear, why did the Russell 2000 pull back? Kind of cap and crap like this. Closing only positive by 1.98 points, or a gain of 0.99%. Not a bad gain, but it should have been the leader if we're talking about clear skies ahead. Look at the sectors on Friday, all positive. Rebound day led by risk on technology. But folks, we've been talking about this for 3 weeks now. The stealth rally in utilities. You gotta look for the consistency. You see, before that, we spotted the consistency of energy. And that was a really good trade until recently when we got a correction. In the last 3 weeks, we spotted the trend and the consistency of utilities. Bad days, utilities up. Good days, utilities up. Now, I don't know how long the trend will last, but utilities leading with a lot of strength. What does that say about the market formation? Sure, you'll have technology up big in a day or two, but the leadership by utilities is defensive in nature, specifically when you have higher yields. Yet utilities continues to go higher. Dividend-paying utilities. There's a message underneath it all, and that message is defensive. That watch out, there's a problem with this economy, and the formation in your portfolios should change. If we look at the weekly performance, you can see that utility is number one by far. Again, that's defensive, not risk on. The laggards, energy down big, that's recessionary. That's not saying that the economy is expanding. And then you have comm services down for the week. Again, not a good indicator for risk on. Things could change now, but we have to see more evidence of that. Otherwise, the formation remains defensive. Just look at the year-to-date performances, folks. This is stunning. If you look at Qs in orange, up a little over 6%. If you look at the XLK, the technology ETF in blue, up a little over 5%. The XLU for utilities outperforming both, up about 8% for the year. Again, I cannot guarantee how long it's going to last, but boy, does it make a point or not. If we zoom in a little more, and take it from the time where the correction began, you can see that the XLU, utilities, positive by almost 6.5%, while the Qs, the NASDAQ, and the XLK technology actually negative during that period. I think it's a clear message. We'll look at the breadth on Friday. The NYSE, 70% advancing versus 29% declining. The NASDAQ, 61% advancing versus 36% declining. All in all, positive close for the week, but things could change this upcoming week. We'll look at the heat map on Friday, positive across the board. You can see that the leadership was, again, the big caps, the Apples, the Microsofts, the Metas, and the chips, of course, led by NVIDIA. So it was a risk-on theme. And the only negative activities we've seen related to earnings, of course, you have the ticker TD. That's not earnings. They got caught washing money for gangsters and stuff, so that goes down. And then we have Eli Lilly, huge weight for the XLV healthcare. So a lot of you have been asking me, do I buy the XLV at this point? You got to be careful because the XLV, the heaviest weighting is Eli Lilly, NVO, and that's all dependent on the Ozempic bubble. And right now we're seeing changes in the Ozempic bubble. You could see other healthcare names moving higher, but the XLV going down because of the weighting of Eli Lilly. What happened on Friday? We see the evolution of the bubble. If you got two companies in a duopoly making a shitload of money, that's going to attract other competitors. And we talked about Amgen as the most reliable one. And this is why we've been long Amgen since last year. And now we're vindicated because Amgen announces they're going to compete with Ozempic and Mounjaro, and they have test results to show. Now, all of a sudden, Amgen gaining market share of a really lucrative bubble, while Eli Lilly losing market share. So we see Amgen gains equals Eli Lilly losses. And this is why I usually say that if you want to buy healthcare, the ETF is okay, sufficient enough, the XLV. Not right now. Right now, you have to be picky. You have to pick your names individually. If we contrast this with the weekly heat map, you can see that it was not a good week for the market. And this is, again, part of the reason why I'm not really sure about next week. I mean, the majority of the gains, when you have Apple up over 8%, Amazon up over 3.5%, that's going to move the major indices higher. But then you look at other corners of this market, be it energy, be it metals, be it industrials, be it the cyclicals, or even the banks. And it doesn't give you a reason to be comfortable here. Even if you look at the technology sector, if you look at chips, Broadcom was down almost 5%, AMD down over 4%. A lot of other technology names were down. Cloudflare crashed. This is cybersecurity. So we have a problem here with this market, and it's not really clear to me that the big caps can continue to perform and just continue to lift the indices higher while we don't see participation from other corners of this market. I think Apple fades a little bit. I think that Google went way too high and it's going to fade a little bit. I think Meta sellers will show up again. I think sellers will show up again in Tesla. Microsoft is in a neutral place right now. It all comes back to NVIDIA. And NVIDIA's earnings are not until late May, so we're not going to have clarity until then. You contrast this with the heat map for the week. For ETFs, what do we see here? TLT was higher. That tells us right away that bond yields were down. That's going to be really good for the small caps, IWM, any yield-sensitive sector, but we divide them in two. So we have the yield-sensitive risk-on. Those are IYR, real estate, XHP, home builders, XRT, retail, XBI, biotech up over 7.5% for the week. And the KRE regional banks up over 3% for the week. But we also have the yield-sensitive risk-off theme. That's the XLP staples and XLU utilities. The problem here is utilities up over 3% for the week, XBI also up over 7% for the week. So it was good for all yield-sensitive names, but it's not giving us clarity whether it is a risk-on or risk-off theme. That's really important for you to understand. Now, it was a bad week for crypto ETFs, all down for the week. We might see a recovery this week, though, and then we see the dollar going down. Did not help gold miners, though. Gold miners down 3.3%. GLD, the SLV silver, all down for the week. The drop in the dollar did not help energy either. Big drop for the XLE, XOP energy. What is the message here? We got a little bit of a recession scare. And that explains the XLU, that explains the performance of energy. But then you have conflicting messages too. You have Chinese equities, FXI, MCHI, emerging markets, EEM, moving higher based on the dollar going down. You have risk-on segments like the XBI biotech with a huge gain for the week. And it's a mixed signal. You can't really decide what the market is trying to do or trying to tell here. And this is why when you're in that situation, the question becomes, do you want to trade it or do you want to wait for further clarity? We segue to commodities on Friday. Crude oil still down for the week, down about 1% apiece for the WTI and Brent. A big drop for the RBOB too, down about 2%. But we see a rebound for nat gas, up a little over 5.5%. They will look at softs with the dollar going down on Friday. We see rebounds in cocoa, but the message is clear. I would say we have at least 90% chance that we already got at the top in cocoa. And coffee now down about 2.5%, a little over 2.5% on Friday. I think we got the top in coffee at least for now. We might see rotations within softs. And we're already seeing that, folks. The laggards, cotton futures up 3% on Friday. We're seeing a rotation into those futures. We see a lumber, which is a good leading indicator for the market too. Lumber up about 1%. So we see a rotation into lumber, rotation into sugar, modest gains, but we're seeing outflows from coffee, OJ, cocoa, inflows in cotton, lumber, sugar. If you look at metals, the dollar was down, then up, and it sent mixed messages to the metals cohort, really sensitive to the dollar. Muted for gold and silver. Same goes for platinum. But then we see copper up about 2%, platinum up a little over 1.25%. What's going on with copper here? It seems that we got, again, mixed messages. If we have a recession scare here or stagflation scare here, why is copper moving higher? I think copper is sniffing the next inflationary bomb, which is a recovery in China, while our economy stagnates. And that's going to exacerbate the problem with stagflation. You see, I look at these leading indicators. Maybe I should be Fed chair because Jerome Powell doesn't do any of this homework. Anyways, meats on Friday, muted across the board, although lean hogs down about 1%. And the recent pullback in the dollar is it reviving grains inflation. That goes hand in hand with copper and the revival of China. I think grains probably found a bottom, and we'll see higher grains prices from this point on. Grab a chart of wheat, you'll see it. Soybean meal up big on Friday. Soybeans up. Rough rice been moving higher. Canola higher, although corn was muted while soybean oil was in the red, be it marginally. If the dynamic continues of the dollar going down or staying muted, but we see more and more recovery news from China, I think grains will be the next trade in commodities. If we look at the conclusion of the week, the winner, natural gas, up a little over 11%, almost 12%, and the loser, cocoa, losing almost a quarter of its value in 1 week. On to the big casino, the options market. What do we see here? The volume moving higher, expiration Friday, higher close for the day. Of course, bring back a lot of options activities, mostly betting on calls. The problem is the majority of the bets are for the week, for next week. Nobody's really having a high degree of confidence to bet big out of the money with longer expiration dates. So if we look at the flows, SPY, Qs, AMD, Supermicro, all bullish flows. Bearish flows, Tesla, Carvana, the cash index, IWM, is that a leading indicator that this week we could see Tesla, Carvana, the winners of this week, going down perhaps? Now, the most interesting trades I could find, here's one for the Qs, the 440 calls for May 17th. Now, I'd go with next week. Either the Qs makes it to 440 or not. Otherwise, I don't want to spend all the way to May 17th. But they paid a premium of about $6 million. So somebody sees more for recovery here, led by the mega cap technology stacks. When it comes to Tesla, here's one that's highly unusual. It is a bearish trade, and somebody sold the 185 and 180 calls with different expiration dates, all coming really soon in the month of May. What is the message from this trade? They're betting that Tesla's going to go down. It's probably going to go down below 185 or 180 in this trade. So anticipation, at least based on this trade right here, that Tesla's going to pull back. Then we have another one, a bearish trade for Qualcomm, a winner for the week. But this is highly unusual. Somebody's fading the rip. They sold the 160 calls for September, and then they sold the 150 calls for June 21st. Now, it is probably a shareholder of Qualcomm selling covered calls or calls in the money, and they're netting a premium of about $90 million. But the sentiment says that they're probably betting that the recent positive reaction in Qualcomm will be faded at least a little bit, and they can keep some of that premium that they netted from selling these calls. Let's move on to more unusual activities. We begin with COIN Coinbase. Bitcoin, it violated my threshold for a day or two, but then it came back. If you're looking at the charts, we'll do that in a minute, maybe. We have higher few days in Bitcoin. If that is the case, then Coinbase is heading higher. And somebody's betting on that outcome. They bought the 237.5 calls for the expiration date May 10th. The expectations, the name will go higher and gain more than 6% by then. Paid about $4 a piece, tenor this trade. All in all, spending about $8 million. Then we have a really interesting one here for the TMF. That's just another proxy, let's say equivalent to the TLT, on bond pricing for the longer end of the yield curve. But here they're fading the rip. In other words, they're betting for a recovery in bond yields. They bought the 44 puts for the expiration date May 24th. The expectations, the TMF will go down and lose more than 6% of its value by then. Paid about 80 cents a piece, tenor this trade. All in all, spending about $1.4 million. Then we have PDD Pinduoduo. Something big is going to happen with this company. We see huge bets to the upside. We see huge bets to the downside. There's another trade here for calls. Pick whatever you want to pick. But this one is a bigger one, so I'm going to go with it. Somebody bought the 132 puts for the expiration date June 7th. The expectations, the name will go down and lose more than 6% of its value by then. Paid about $5 a piece, tenor this trade. All in all, spending about $4 million. Then we have the ticker NOX. This is one of the companies that NVIDIA is investing in, and somebody sees it going higher. They bought the 10 calls for the expiration date June 21st. The expectations, the name will go higher and gain more than 7% by then. Paid about 75 cents a piece, tenor this trade. All in all, spending about $400,000. And lastly, at the bottom of the table, we have the ticker TDS, and this is really interesting because the chart looks comical. It was up, then it went down, and year to date, the name is down over 21%. And this is, of course, for a company called Telephone and Data Systems. Somebody's betting that we have more pain to come because there's a gigantic bear flag that's playing out, and they bought the 12.5 puts for the expiration date June 21st. The expectations, the name will go down and lose more than 13% of its value by then. Paid about 70 cents a piece, tenor this trade. All in all, spending about $350,000. Let's segue to the charts and then wrap it up, folks. We begin with the SPY, the S&P 500, an hourly chart. What do we see here? Let's begin with the red line, 507.37. You're above, you gotta be bullish. You're below, you gotta be bearish. Why? Because it is the shoulder line in what was or supposed to be a head and shoulder topping pattern. Didn't happen. We got a gap higher instead. Now, the bears would argue, oh, it was a bull trap on Friday. That's all good talk. But confirmation is losing 507.37. Then we know, okay, it was a bull trap, and back we go to the head and shoulder. We break the trend line. Now we got a revisit of the lows. Absent of that, right now, the bulls got the momentum, but they got to be careful. They don't hit a double top at this point and form an inverse ABC where they actually go below 507.37 and close the gap. So long as we're trading above 507.37, the bet is higher we go. We lose it, got a different story. Daily chart for the SPY, what do we see here? Right off the gate, we look at the momentum indicators. Is the MACD changing from bearish to bullish? Yes. Is it decisive? No. But you can't dismiss it either. The RSI, is it trending higher or lower? The answer is higher. That's bullish. The Vortex indicator. You see the blue line about to cross above the red line. That's a bearish to bullish reversal. Now, the only confirmation we don't have is a close above the 50 days moving average in blue, 511.54. That didn't happen. If it happens, you gotta assume we're heading back to the upper Bollinger Bands, 520.21. We don't make it at the 50. We lose the 20 in white, 20 moving average, that is, 506.77. Then you know that we're heading down, or we're probably heading down to the lower Bollinger Bands, 493.33. Do you understand now why I'm waiting on the sidelines? I'm waiting for a better confirmation. And of course, we have the trend line that's still intact. If we lose it, more for confirmation, then we go to the lower Bollinger Bands at around 493.33. We look at the E-mini futures hourly chart. What do we see here? The bear boss was at the top of the bearish engulfing candle at around 51.18. We're trading above. If we trade below, then we have a different story. Doesn't mean that we're flipping back to bearish, but it means that maybe there's a chance that Friday was a bull trap. Confirmation, the bears got to defeat the bull boss who's sitting at 50.22.5. You go below that, confirmation, it's done. The Q's hourly chart, what do we see here again? Topping head and shoulder, erased by Friday's gap higher. That's no longer valid. Until what? Until we go down and we lose 430. Now, the threat for the bulls is, what if it is indeed an inverse ABC? You got to watch the hourly MACD, of course. If you see it turning around and maybe the green column's getting shorter, we're about to cross. And we see red columns. Are we losing 430? Okay, now you got a confirmation that it is a bull trap. And down we go perhaps to the shoulder line and beyond. If we look at the daily chart for the Qs, what do we see here? MACD, bullish or bearish? Well, changing from bearish to bullish. RSI, bullish or bearish? Positive divergence, that's bullish. MACD, which line is moving higher, the blue or the red? The answer is the blue. That's going to be bullish. Now notice that we're looking at daily charts. We're not looking at the weeklies because that's a different story. But the weeklies will give you confirmation for bearishness if we lose the 20 weeks moving averages on those charts. So for now, we're going to stick with the dailies. The only confirmation left here is closing above the 50 days moving average 436.39. If that happens, you got to assume we're heading back to the upper Bollinger Bands. If not, we lose the 20. That's sitting at about 430. You see the importance of the number. Then we're probably going to head back to the trend line in yellow. We lose the trend line. Down we go to the lower Bollinger Bands at 414. NASDAQ futures daily chart. What do we see here? Higher low, sure. Bullish momentum in the MACD, in the RSI, in the Vortex, sure. Are we above or below 17,735.75? We're above. So we got all kind of bullish confirmations we need. Now comes the next confirmation. Do we keep that line, or we go above, say, 18,121.5, or do we go down and take that support? And this makes the number 17,735.75 the most important number for you to watch in this chart. And again, take notes. Now we have multiple numbers and confirmation layers to look at to know what the next move is. In this chart, it is 17,735.75. Now, the bears would argue, but this is a bear flag channel, Maverick. It's going to go down. It's going to break to the downside. Here's my response to that. If we trade above 18,121.5, you no longer have a bear flag pattern. If we lose 17,735.75, then there's a big chance that indeed it is a bear flag and it's going to play out confirmation, losing 17,210. If we look at the IWM hourly chart, what do we see here? Again, disappointing, at least if you were in the bullish side, to see the IWM kind of gapping and then crapping in a bear flag pattern. If yields are indeed going down, then why the hesitation? Why not just go all the way up and close the gap above? So this is kind of peculiar, but the confirmation, if we lose 201, that we do have a bear flag, we're going to close the gap and perhaps trade below the gap again. Good news for the bulls. You still got a pattern of higher lows. If that's broken, you got to grab the diapers. If we look at the daily chart, what do we see here? MACD, bullish or bearish? Bullish. RSI, bullish or bearish? Bullish. Vortex, bullish or bearish? Bullish. Here's the only problem though. We got rejected and we lost the 50 days moving average at 202.19. If we head down to the 20 days moving average, 198.20, and we lose it, bull trap, down we go. If we go above the 50 again, you got to assume that the upper Bollinger Bands will be the next target that's sitting at about 205.73. Weekly chart, what do we see here? The most important number in the weekly chart would be 205.49. So that comes before the daily upper Bollinger Bands. And of course, the weekly closing is what really matters. Now, why is this number important? Because if we get rejected from this number and we head down, then we're probably going to have a topping head and shoulder on the weekly chart, and that's more decisive than a topping head and shoulder on a daily or an hourly chart. Here's the dollar, Dixie. Daily chart, you can see the big rebound from the 50 days moving average in blue. And that didn't give me enough comfort to say I got to follow the MACD or the Vortex or the RSI. All of them giving me bullish indicators to the market, bearish for the dollar. This rebound keeps you on edge. That what if the dollar makes it above the 20 moving average again? Then the bearish momentum in the dollar was short-lived, which means that the bearish momentum in the equities market was also or will be short-lived. And if the dollar was indeed heading down, then why did the old man gold react like this? Didn't really rally. It seems that the old man wants to expand the lower Bollinger Bands down and play yet another bear flag pattern. So for now, gold is not giving us the all clear for equities, for the dollar, and certainly if you want to buy the dip in gold, we're not there yet. If you look at the GDX gold miners, again, if the spot price of gold goes down, now that we have the two most important earnings, New Mountain and Barrick Gold, out of the picture, the spot price becomes more important in trading the GDX. And right now, we can argue that we have perhaps a bear flag pattern if we don't make it above the 20 days moving average again. At 33.67, down we go after we lose 32.92. We expand the lower Bollinger Bands, which means, again, bearish confirmation, not bullish. The SLV is perhaps your leading indicator if you're trading gold, whether we're going to have a recovery or not. And the theory goes, if we have a recovery in gold coming, of course, you'll spot it by the action in the dollar, but perhaps silver usually a leading indicator. And right now it goes, what if this is a falling wedge pattern? We break to the upside. Remains to be seen, but of course, Monday's action will be decisive. It gotta happen Monday. If it doesn't happen and down we go in silver again, then we don't have it and the bearish momentum continues. If you look at UK oil, Brent oil, what do we see here? Big correction in a matter of 2 weeks. The bear flag played out. We never really made it above the 20 days moving average in white, 87.77 right now. And that was a confirmation that the bear flag is going to play out. Now, are we oversold? The answer is yes. We're at the lower Bollinger Bands. We're awaiting a recovery. But this kind of move in oil is recessionary in nature. This week will lack macro data. It will be all about earnings and all about technicals. So if you follow that, we see a rebound coming in UK oil this week. But you gotta be careful because right now we still got a topping head and shoulder pattern. So rebound might get you all the way to 85, but you still need to get above the top of the breakdown candle and then above the 20 days moving average and then above 89.61 before you eliminate the topping head and shoulder. The leading indicator would be the big kahuna in energy, ExxonMobil. Daily chart. We see a rebound almost from 114, the support that we got. Looks like a bottoming candle. We need to see more. Now, if you must trade this week, I would say maybe Monday, if I have to trade, I'd go with Exxon calls. And if we begin to see a recovery in Exxon, that will be a leading indicator that perhaps we have at least a short-term bottom in energy. Another supporting evidence for a rebound in Exxon would be a falling wedge pattern that breaks to the upside. A lot of you, of course, want to buy the dips in a lot of energy names that went down, specifically the refiners, MPC, Marathon, great stock, but you need to see a recovery in the spot price first. You need to see a recovery in the gasoline RBOB. The chart right now is sitting on the 20 weeks moving average. That's the red line. If we close below 177.60, run for the hills. If we maintain and we continue to move higher, you gotta trade, you stick with it, but you cut loss 177.60. That's gonna, of course, change throughout the week as we see the 20 weeks moving average also following the chart. If we look at the 10-year yield daily chart, what do we see here? Look at the MACD, bearish momentum, got it. RSI, negative divergence, got it. The Vortex indicator, red line above the blue, got it. All saying bearish momentum is in play right now. We lost the 20. Question now becomes, since we're really close to the lower Bollinger Bands, is the correction over in the 10-year yield? Are we about to head higher? We look at the weekly chart. We see that we got outside of the upper Bollinger Band, so we got a correction right now, but it's not really decisive to say that we formed a lower high, and down we go on this chart. If you combine that with the bet that we got in the options market for the TMF, or against the TMF, I should say, I don't think that the 10-year yield went all the way up here to just give up and go down. What does that do to the yield-sensitive XHB home builders weekly chart rebound of the 20 weeks moving average? So far, so good. Do you go with it? Do you bet on the upper Bollinger Bands here on the weekly chart? Let's zoom in to a daily chart, and here, sure, we got the MACD changing to bullish. We got the RSI also changing to bullish. So is the Vortex indicator. We're above the 20 days moving average. Got it. Problem is, it's a bad looking candle. It's a topping candle. Unless I see a reversal of that candle, I'm not going to go with the XHB calls. What if we go down to the 20 days moving average again, close the gap and trade below the gap? For now, there is nothing for me to do here in this chart. And the same goes for the IYR. See, if we closed above the 200 days moving average in blue, I would have said higher we go. You gotta bet to the upper Bollinger Bands in the IYR. We buy the 87 or even the 90 calls. But then came ISM Services Survey, indicating stagflation. We have seen a reversal in any yield-sensitive ETF, IWM, XHB, IYR, and it doesn't really give you a degree of confidence the higher we go. It only does if we go above the 200 days moving average in blue. Otherwise, if we lose the 20 days moving average in white, then our forecast from last week is still here. Then once we break the lows, weekly chart plays out and we head to the ultimate lows in the IYR. How about the KRE regional banks hourly chart? What do we do here? I think it is a really good chart to trade on an hourly basis, but it's not a good chart to trade for longer than that. Daily time frame, weekly, we've been in a range. So if we look at the hourly chart, we have a gap here, but in a bear flag pattern. We see the MACD indicator back to change from bullish to bearish. Can we bet on closing the gap? Yes, we can. But after that, what do? The trade is over. So the opportunities are limited in the KRE. It's been in a range for a long time. The VIX Volatility Index hourly chart, what do we see here? You can see the pattern changing from higher highs and higher lows to lower highs and lower lows. And we see the market rebounding. And of course, the top was the bear flag, the reversal pattern. Question now becomes, are we just stretching the rubber band before we see a big explosion higher in volatility? That's what the bears will be betting on. And it's all good thought and good commentary, but at the end of the day, in my perspective, if we look at the weekly chart, my line in the sand, and viewers of the show, regular viewers, you know that, it's been the 20 weeks moving average in white. If we close above from weekly basis, be careful, we have a correction coming in the stock market. If we close below, you gotta assume that the risk is higher in the stock market, meaning upside risk. And right now, we closed below the 20 weeks moving average. So I gotta go, at least for now, that the most immediate risk in the market is to the upside. Now, if the VIX makes a recovery and closes above the 20 weeks moving average again, then we can talk about that. But right now, the setup says upside risk in the market more than downside risk. The Big Kahuna Apple hourly chart, what do we see here? We got the buybacks pump, but is it going to fade? My hunch is yes, at least some of it will fade. Maybe in an inverse ABC pattern, but we have to identify targets using the daily chart. Now, right now, it's way outside of the upper Bollinger Bands, meaning that even if Apple is going higher, it's not going to do it right away. It will probably consolidate before it does that. What does that mean? From a trader's perspective, it makes it easier, maybe a weekly trade, maybe for 2 weeks, to sell some calls. Perhaps opening credit spreads, and then bet on a pullback all the way down to the 200 days moving average in blue, sitting at about 181. And then after that, if we get a rebound off the 200 days moving average, okay, perhaps higher we go after that. If we lose the 200 days moving average, then we have support number 2 at the upper Bollinger Bands. If we lose that, then we can bet that the gap will be closed. Souffle Tesla hourly chart, what do we see here? A lot of you want to short Tesla, but on the hourly chart, it's not clear yet. If anything, it shows that perhaps the MACD indicator is changing from bearish to bullish. Of course, this is hourly, so it doesn't matter a lot. On the daily chart, what do we see here? Got a correction off the upper Bollinger Bands. We played that, but now what? I don't think we have a bearish trade here until we lose 174.17, the 50 days moving average in blue. Because right now, the risk of a bull flag formation is still here. If we lose the 50, then we can talk about, okay, no bull flag, and we're going to close some of the gaps below. On the weekly chart, what is the threshold to watch for? 20 weeks moving average, 192.34. You close above, the bulls got it, higher we go. We get rejected here. And we move down and we lose the 50 days moving average. Understand that the weekly chart will probably close the gap below. I mean, this is a weekly chart. It's not going to allow a gap like this to remain open. And then perhaps after that, we go down further below. But it's a one step at a time process, folks. NVIDIA, hourly chart, what do we do here? You're above 860, you're bullish. You're below 824, you're bearish. We're now above. We have a gap below. It seems to me that at least we might go down to close that gap and then see what happens. If we keep 860 good to go, if we don't, then the bears will begin to gather more momentum. And this is the most important stock in the market right now. If we look at the daily chart, is the MACD indicator changing to bullish? Yes, check mark. So is the hour size, so is the vortex. Are we above the 20? Yes, we are. Are we above the 50 days moving average in blue? Yes, we are. So the bet right now is on the daily chart, forget about the hourly, daily chart, that we head back to the upper Bollinger Bands. But there is a catch. You see, for now, we have a pattern of lower highs. And so far, the last high hasn't been defeated. So your confirmation will be beating 888.19. Then you got to trade to the upper Bollinger Bands. If we stall here, we form a double top. We lose the 50. We lose the 20 at 850.22. Then we go to the hourly chart and we lose 824. Then we got a problem. Down we go to the lower Bollinger Bands and then beyond to close the gap below at 680. Last but not least, Bitcoin tulips. What do we see here? It lost my threshold for a day, but it was outside of the lower Bollinger Bands. So we got a recovery now. And it appears that we're above the 20 days moving average. And the daily MACD is changing to bullish. Doesn't mean that Bitcoin is going to go higher in a big way. It means you might get a pop all the way to the upper Bollinger Bands, but then the chart is bounded by the boundaries of the Bollinger Bands. Bitcoin bears would look at the weekly chart and say, but Maverick, the momentum is changing from bullish to bearish. Got you. Get confirmation. Lose the 20 weeks moving average. 55,761.5. You lose that, we can talk. We can say that we're going down, perhaps all the way down to the lower Bollinger Bands. Confirmation that we're going to lose the 20 weeks moving average. You go back to the daily, 59,224. You break it twice, it's not a coincidence. It is saying that the weekly chart is going to break too. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Not a lot. Monday, May 6th, we have a bunch of Fed zombies from Richmond and New York. Barkin, Williams, who cares? Tuesday, May 7th, more Fed zombies, this time around from Minneapolis, Kashkari. And then we get consumer credit. Wednesday, the 8th, we have wholesales inventory. Then a bunch of Fed zombies speaking from Jefferson to Collins, Boston, and of course, Governor Cook. And then when it comes to Thursday, May 9th, we have initial jobless claims. Important, but not the most important piece of data. Then we get another Fed zombie from San Francisco this time around, Mary Daly. Friday, May 10th. When it comes to the economic data, we have the preliminary reading of consumer sentiment. We have the monthly federal budget, but that's not really that important. Then, of course, more Fed zombies. This time around, Governor Bowman from Chicago, Zombie Goolsby, and the Fed Chair of Supervision, Michael Barr. Again, lack of macro data. What is the importance of this week? The Fed blah, blah, blah talk. Whatever they say comes out of their holes. The market might listen, be upset, or be thrilled and goes higher. So it's not a week where I could really trade easily. So I'm going to step to the side, folks, and take a break. So again, it's going to be a bonus video week. If we get a major movement, we'll do a short show, and cover the events. But with that, take it easy, folks. And if you enjoyed the show, help us out here. Press the like button. It takes a second. Leave a nice comment. Subscribe to the channel. Help us out by becoming a member and access the daily show, the bonus videos, Discord benefits, here on YouTube or better yet on Patreon so you don't have to pay the evil empire. But with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Let me see that again.
Okay. 1,
Yeah.
2.
Oh, boy.